Can Travis Kelce, the three-time Super Bowl champion tight end for the Kansas City Chiefs and the fiancé of the world's biggest pop star, Taylor Swift, turn around Six Flags Entertainment, North America's largest regional amusement park operator? Now, if you asked me that question a little over a month ago, I would have said, what are you smoking here? But because, you got to believe it or not, this is now a real question investors are grappling with. See, Six Flags, as we know it today, was created last year by a merger of equals between the old Six Flags and Cedar Fair, which was another heavy hitter in the amusement park space. Like a lot of people, I thought the deal was going to be terrific, but that turned out to be a spectacularly bad call. Ever since Six Flags and Cedar Fair combined last July, the stock's down a stunning 73%. God, that's awful. What went wrong? In a word, everything. Six Flags has been hit with macroeconomic headwinds and some very company-specific problems, creating a perfect storm of poor attendance. Back in August, the Wall Street Journal ran what I can only call a very depressing profile of the company's cascading series of problems, which resulted in a no-good, very bad, terrible quarter this past summer. Now, some of it's beyond the company's control. Earlier this year, Six Flags was hit with real bad weather, with severe thunderstorms, and I've got to tell you, some really brutal heat waves hurting attendance. Some of their locations even had to shut down for multiple days at a time. This happened early in the season, which is when these companies usually sell those lucrative seasonal passes. At the same time, Six Flags has definitely been hurt by the declining health of the consumer, especially the lower-income consumer. These regional theme parks are seen as more cost-conscious vacation options than, say, going to Disney World, which is far, far more expensive. But because Six Flags is more levered to lower-income consumers, they feel more pain,
the house of pain,
when things get tougher. So attendance is going to get hit. No matter. This would be a bad environment for Six Flags no matter what, but it's not like they've been handling the situation that well. The Journal profile in August mentioned a new ride called Siren's Curse at the Cedar Point amusement park on the shores of Lake Erie, just west of Cleveland, forming the crown jewel of Cedar Fair's portfolio. The ironically named Siren's Curse was supposed to be an important new draw, but it ended up breaking down several times throughout the summer. One incident in July left riders stranded over 100 feet in the air. No one was hurt, but the story went viral. Not exactly good advertisement. In another example, it's a bit closer to home. Six Flags announced last November that it would tear down a few different rides at Six Flags Great Adventure in New Jersey and replace them with new ones that were to be open in 2026. But this July, the company announced that the replacement rides in the New Jersey park won't open until 2027. We've seen similar delays at Six Flags parks in Massachusetts. Operational issues. On top of that, management hasn't quite delivered on some big promises they made at the time of the merger. While Six Flags has pushed through some layoffs and cost cuts, there was supposed to be this revenue boost from selling season passes for the combined Six Flags Cedar Fair. Almost a year and a half into the merger, and we're not seeing any meaningful benefit to the company's attendance or overall business. Whether you want to attribute it to the broader economy or to company-specific execution issues, attendance at the parks has just been awful. In August, Six Flags reported that attendance for the combined company was down 9% year over year during the second quarter. When attendance is down, fewer people pay up for the fast passes that let them cut in line. It's just not worth it if the line's not particularly long. At the same time, fewer people means weaker food and beverage sales. Put it all together, it translates into a big earnings. So these things are really levered to what happens if you get a lot of people in and they're not getting them in. What makes this so much more worse? Six Flags has a terrible balance sheet. That's why the stock's really obliterated. Both Six Flags and Cedar Fair went into a merger process with a fair amount of debt. And the current Six Flags now has a sky-high leverage ratio of 6.3. Anything above 3 is considered high. Anything above 4 is very high. And anything above that is, well, let's just say precarious. Now, in August, after Six Flags reported a putrid second quarter, we learned that CEO Richard Zimmerman will be stepping down at the end of the year. He'd done a good job at Cedar Fair before the merger, but at this point, investors are glad to see him go. Since then, they've been looking for a successor, and this is where the Travis Kelce connection comes in. On October 21st, Jana Partners, which is a big activist investor firm, announced that it had partnered with Kelce and a couple of other individuals, taking a 9% stake in Six Flags. Now, is Kelce really that involved in this whole deal? I have no idea. But with the Chiefs at 6-5, currently on the playoff bubble, and a big wedding to plan with Taylor Swift, I doubt he's got too much time for Six Flags. But it's still a fun story. And for what it's worth, that Jana Partners announcement got plenty of attention, perhaps because Kelce's name was included. The stock popped nearly 18% on the day that the news broke. Unfortunately, those gains were short-lived, in large part because a couple weeks later, Six Flags reported a dismal third quarter. The good news, attendance was up in the third quarter, albeit only about 1%. The bad news was everything else. First, Six Flags said that after a strong performance in July and August, attendance trends moderated in September. And for the 5-week period ended November 2nd, attendance was down 11% year over year. That's heinous. Sales and earnings before interest, taxes, depreciation, and amortization both missed expectations. And for the second quarter in a row, Six Flags slashed its full-year EBITDA forecast. That is brutal. Now, this morning, we got some interesting news, though. Six Flags is bringing in John Riley from Palace Entertainment U.S. as the next CEO, effective December 8th. Before that, he worked at SeaWorld. He's got some terrific turnaround experience in the theme park business. Janus Partners put out a statement in support of the hire. So back to the original question, can Travis Kelce save Six Flags? Obviously, it's a little tongue-in-cheek. The real question is whether Janus Partners, in combination with Kelce, can help save Six Flags. And the answer, only if the company lets them. Janus got a great track record. Maybe Kelce can rope in Taylor Swift's legion of fans on top of Chiefs fans. Given that they like the new CEO, I'm feeling a little more optimistic about Six Flags, especially with gasoline prices coming down hard. That said, it certainly won't be easy because right now this company is a disaster. Before they can turn anything around, they desperately need to clean up the balance sheet and maybe close some more underperforming parks. Here's the bottom line. While Six Flags' new management should be able to turn things around with some help from Janus Partners and Travis Kelce, I wouldn't stick your neck out in this one unless you're willing to be incredibly patient because it's going to take a while, and there's always the chance that the company itself can't make it if the weather's bad or the parks keep having operational issues. Let's take some calls. Let's go to Michael in West Virginia. Michael.
Booyah, Jim. Mad Mountain Money Mike here. How are you tonight?
Well, I am doing well, Mad Mountain. How can I help you?
Well, I've been reading this wonderful book, How to Make Money in Any Market, using it in this tricky market. Back in July, I needed some caffeine. I bought an OK cup, KDP, Jim. Am I in good shape there?
Yeah, I think you are. They're cleaning the thing. Oh, by the way, thank you for those nice comments about how to make money in the market. They're doing some good things. The stock is down huge. Yields 3.3%. I think that's a safe yield. I would actually join you in that. We did a piece saying that maybe this is finally the bottom, and I think it very much is. And thank you for the kind comments. All right, I'm still optimistic Six Flags can turn things around, but they need to lean into the support from Janus Partners and from Travis Kelce in order to make things happen. Now, much more made money at it. Last week, we covered some dividend stocks that were worth watching in a volatile tape. And with an over 5% yield, does Kimco fit the bill for your portfolio? I'm checking in with the CEO. Then you can't forget what really slays bull markets. I'll reveal what it is and why I worry we might be getting near there. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.